Joining us today is Patrick Winsbury, Senior Vice President, Financial Institutions Group for Moody's Investors Service, who will be speaking at IIR's Basel III conference, which takes place on the 24th to 25th of March 2011 in Sydney. Hello Patrick, thanks for joining us today.
Oh, thank you.
First of all, what's Moody's view on bank capital rules?
Well, we think that Basel III definitely has more teeth than Basel II if we take a big picture view. However, there is a long phase-in period which we think reflects the challenges that the new rules are going to pose for some banks. And yet at the same time, we also think that there's going to be market pressure on banks to comply faster than the scheduled pace. So there's going to be an interesting dynamic to watch. Some other interesting issues around this are the reach that the Basel III rules may have. It now looks like we might have a scenario where you have implementation in all G20 countries, and in addition, you're going to have close attention paid to these rules in other countries around the world. But when it comes down to it, despite the many positives that we see in the Basel III initiative, it's just one building block in terms of creating a sounder environment for financial institutions. And there are a lot of other elements that need to be considered. For example, coordinating accounting standards, thinking about macro issues, surveillance, harmonization of standards, and so on.
And how are Australian banks coping with the Basel guidelines, and how does this compare with overseas banks?
Well, in terms of capital, the Australian banks are actually looking very strong. There's a number of reasons for this. Firstly, the capital adequacy calculation methodology adopted by the local regulator was more conservative than required when they moved from Basel I to Basel II. Secondly, we've of course had a very good crisis. The levels of loan losses have been pretty small, so we haven't seen capital eaten into. And in fact, the banks have been very proactive in increasing capital. So the area of uncertainty around capital really now depends on how the local regulator will take the new rules, whether they're just going to take the areas where the new rules are more conservative than current standards, which are actually very few, or whether they're actually going to relax some of the more punitive parts of the calculation methodology here. Our view is that even worst case, the level of capital shortfall is likely to be quite small and easily accommodated by internal capital generation. The liquidity story is much more challenging. The banking system here has a structural reliance on wholesale funding, and there's a shortage of liquid assets. So, to be fair, the Australian regulator was actually already working on liquidity in the banking system before the crisis, and much of what's come up in the Basel discussion is sort of along the lines that was already being discussed here. The net stable funding ratio appears the more easy of the two to accommodate, given the fairly lengthy period in which it's possibly going to be implemented, and therefore give the banks time to, in particular on the funding side, lengthen tenors so that that ratio is easier to meet. The real challenge is the liquidity coverage ratio, and the key issue there is the definition of what core liquid assets are. In Australia, the government bond market is very small, so there simply aren't enough government bonds on issue for the banks to meet this ratio. And the local regulator doesn't allow covered bonds either. So we're going to need some kind of specific market solution, which is envisaged under the latest Basel III approach.
And how will Basel III impact on bank credit quality and ratings?
Well, this is something that we're obviously occupying our mind. On the face of it, you would have thought that higher capital and liquidity are likely to be a positive rating factor for the vast majority of institutions. Obviously, there is going to be a negative impact on profitability, which, given that we're looking at a balanced scorecard as a negative, and perhaps more importantly, we would have to start considering the returns that are going to be required from investors on the banks, and unless those moderate in line with the restructuring of banks to this higher capital holding, one of the things that we would need to think about is what the incentives will be on management to maybe take on more risk in areas that we might not anticipate in order to boost their returns.
Will Basel III truly assist in preventing or alleviating another global financial crisis?
Well, as I think I hinted earlier on, we think that there are a number of other building blocks that are going to be necessary. So there's a lot of leeway in definition of capital standards and interpretation, and that is a first element that is going to be difficult to address. Secondly, we still have some very different accounting standards that make it even more difficult to view really what's going on. And the area of macro risks is of course falls outside of the scope. So of Basel III, and is going to require a concerted effort at a policy-making level. In addition, there are ancillary components to this in terms of compensation structures at banks, and what is the best way to ensure strong supervision and enforcement.
You're speaking at IIR's Basel III conference, which takes place on the 24th to 25th of March 2011 in Sydney. What other aspects will you be focusing on in your presentation?
We're going to be focusing largely on the impact on bank credit quality as we see it, and drawing up some of the things that we've learned as we've started to go through the process of talking to the banks and their consideration of the Basel III proposals as they stand.
Patrick Winsbury, many thanks for your time today.
Thanks very much.